Hey everyone! Welcome back to our Taxtron support channel. Today, we are diving into an important topic for Canadian taxpayers: TOSI exemptions. If you have ever heard about the tax on split income or TOSI and wondered how it works, or more importantly, how to avoid unnecessary taxes, this video is for you. To give you a quick overview, TOSI is a rule that aims to prevent income splitting among family members just to gain tax advantages. If certain income is split with family members, like dividends or interest from a private business, it could be taxed at the highest marginal rate. But, don't worry. There are ways to avoid being hit with these taxes, through what we call TOSI exemptions. Let's go through them. Number 1. Excluded business. The first exemption is for excluded business. This one is important for anyone who actively works in their family business. If you are an adult family member and you work in the business for at least 20 hours per week during the year, or in any 5 previous years, the income you earn from that business is exempt from TOSI. The great news is that those 5 years don't have to be consecutive, so as long as you have worked actively for any 5 years in the past, you're covered. Next up is excluded shares. For shares to be excluded, here is what needs to happen. Less than 90% of the corporation's business income should come from providing services. So, if your business makes most of its money from products or something other than services, you are in the clear. But keep in mind, certain shares, like preferred shares, do not qualify for this exemption. The shares you own must represent at least 10% of the voting rights and value of the company. Basically, you need to have a significant stake in the business. Lastly, the corporation should not be getting most of its income from another, related business connected to you or your family. Now let's dive into the reasonable return exemption. This one is super important because it considers whether the income you're receiving is fair based on your contribution to the business. Basically, if the income you are getting reflects the value of what you put into the business, it could be exempt from TOSI. But what counts as a reasonable return? For the income to qualify as reasonable return, several things are taken into account. Such as: work performed, did you work for the business? The more you contribute through labor, the more likely your income will be considered reasonable. Property contributed, did you invest money, equipment, or other assets in the business? Your contribution of property matters too. Risk assumed, did you take on any financial risk in the business? For example, did you invest your own savings or personally guarantee a loan? The more risk you take, the more likely your return will be considered fair. Total payments, how much have you received overall? The government will look at whether the total amount paid to you is in line with your contribution. Other relevant factors: there might be other details about the business or your role that make the income reasonable. So, if the income you are getting matches the value of your work, investment, or risk in the business, it is considered a reasonable return, and TOSI will not be applicable to it. This exemption ensures that people who are genuinely contributing to a business are not unfairly taxed. Number 4. Age 65 or older. For those age 65 or older, if you receive income that would have been exempt from TOSI if it were paid to your spouse, you are also exempt. It is a simple but helpful rule for older Canadians. Number 5. Safe harbor capital return and arm's length capital for ages 18 to 24. Now, if you are between the ages of 18 and 24, there is a special exemption related to safe harbor capital return and arm's length capital. These terms may sound complicated, but let's break them down. Safe harbor capital return applies when you have invested your own money into a business, and the return you are getting does not exceed a specific amount set by a formula. This makes sure that the return you are receiving on your investment is reasonable and not subject to TOSI. Arm's length capital refers to property or investments you have put into the business that did not come from a related person or from income derived from a family business. So, if you invested money you saved up or borrowed from a bank to help the business grow, this income could be exempt from TOSI as long as it meets the criteria. For younger individuals, ages 18 to 24, if your return is based on your own investment, either under safe harbor rules or from arm's length capital, this income could be exempt from TOSI, making sure your earnings are taxed fairly. Let me take a real-life example. Suppose a child, age 25, has a degree in culinary arts. After working in different well-known kitchens, this child opens their own restaurant, let's call it Foodco, where the child is the sole shareholder. Now, because new restaurants are high-risk businesses, the child could not secure financing from banks or other typical lenders. So, the child's mother steps in, providing part of the startup capital through an interest-bearing loan to Foodco. The rest of the capital comes from the child's friends and the child's own savings. So, what does TOSI have to do with this? Normally, interest paid from a private company to a family member, like the mother here, could be subject to TOSI, meaning it would be taxed at the highest rate. But in this case, the interest that Foodco pays to the mother qualifies as an excluded amount because it falls under the reasonable return exemption. Why? Well, the interest is based on the property, the loan, that the mother contributed and the risk she took by lending the money to a high-risk restaurant business. In other words, the return she's getting matches the risk she assumed, and that makes it a reasonable return. What's important here is that the interest rate charged by the mother is higher than what you usually get from a bank loan. However, it is on par with the rates that the friends charged. Let's understand TOSI and excluded amounts in a family business scenario. A 25-year-old culinary arts graduate opens a restaurant called Foodco after working in various well-known kitchens. The child is the sole shareholder of Foodco. The mother provides part of the startup capital through an interest-bearing loan. The rest of the capital comes from friends and the child's savings. That is all for today's video. Understanding these exemptions can help you avoid being taxed at the highest rate. If you think any of these apply to you, it is worth taking advantage of them.